everyone, let's jump right in, because in this explainer, we are unpacking an absolute masterclass in corporate scaling. We're taking a deep dive into Morgan Stanley's explosive Q2 2026 earnings report. If you've ever wondered what a massive financial machine looks like when it's operating at a highly optimized level, well, this is it. It's an incredibly fascinating look into how one of the world's most recognizable banks orchestrates serious growth across multiple global divisions, all at the exact same time. So I want you to start by just visualizing this number, $10 trillion. Take a second to really try and wrap your head around just how massive 10 trillion actually is. That's the new milestone Morgan Stanley just hit in total client assets across its wealth and investment management divisions. It's a staggering milestone, and it really sets the baseline for the sheer scale and gravity of the operation we're about to examine. And, that massive scale, it leads us directly to the inciting incident of this particular quarter, a record-breaking $21.3 billion in net revenues. That's up from $16.8 billion just a year ago. It's a highly significant leap for a single 3-month period. So the big question for us today is, how exactly did they manage to achieve this staggering figure? What were the internal mechanics driving this surge? To answer that, let's actually bring in the human element leading this charge. CEO Ted Pick summed it up perfectly by pointing to, quote, active markets and consistent execution across all 3 regions. What he's highlighting here is that this wasn't just some isolated win in one lucky corner of the business. This growth was a highly orchestrated, unified effort across their entire integrated firm. Basically, a rising tide lifting all ships scenario. Okay, let's dive into this. Here's our roadmap for dissecting the anatomy of this record quarter. 1. A record-breaking quarter. 2. Institutional securities surges ahead. 3. The wealth management engine. 4. Steady investment management. And 5. Returns to the shareholders. We'll start with the macro picture, break it down division by division, and then tie it all directly back to the investors. Section 1. A record-breaking quarter. Let's look at the top-down growth and see how that revenue translates to actual profitability. All right, look at this year-over-year contrast. We're looking at earnings per share, or EPS, jumping from $2.13 in Q2 2025 to a record $3.46 in Q2 2026. This isn't just a slight bump, right? It's an incredible surge in profitability. They also reported a pre-tax income of $7.3 billion, which clearly shows that all that top-line revenue growth successfully translated straight into bottom-line profits. So where exactly is all this coming from? Well, we can slice this $21.3 billion pie into 3 distinct engines that power the Morgan Stanley machine. You've got institutional securities taking the lion's share at $11 billion, followed by the wealth management engine generating $8.9 billion, and finally, investment management contributing a steady $1.6 billion. Section 2, institutional securities surges ahead. Let's zoom in on that first and largest piece of the pie. Check this out. In literally just 1 year, institutional securities jumped from $7.6 billion to a record $11 billion in net revenues. That is a massive 44% leap. I mean, when your biggest division grows by nearly 50% year over year, you're definitely looking at the primary driver of the firm's overarching success for the quarter. Now, what's really interesting about this breakdown is exactly where that $11 billion came from. Breaking it into subsegments, equity dominates at $6.3 billion, with fixed income at about $2.45 billion. But look at this. Investment banking revenues jumped an incredible 58% from a year ago. This was largely fueled by a huge increase in completed mergers and acquisitions, new public stock offerings, and corporate capital raising. I want to focus on that equity segment for just a second, because hitting a record $6.3 billion, which is a 69% increase year over year, is an absolute standout achievement. Now, favorable market conditions played a big role for sure, but the report specifically calls out robust client engagement and standout performance in Asia. It's a perfect example of how having a diversified global footprint lets a firm capture the upside in specific international markets. Section 3, the wealth management engine. Let's shift gears to the second massive engine driving the firm, providing incredibly vital, recurring stability. So the absolutely crucial point is right here, $148 billion. That is the jaw-dropping amount of net new assets added by wealth management in just this single quarter. To put that into perspective for you, they only added $59.2 billion in the exact same quarter last year. It's literally a torrent of new client capital trusting the Morgan Stanley ecosystem. And all this new capital basically powers a few key mechanics. We're talking higher asset management fees, robust client transactional activity, and increased net interest income from sweep deposits, which, if you aren't familiar, is basically uninvested client cash that gets automatically moved into interest-bearing accounts. All of this combined pushed wealth management's net revenues to a record $8.9 billion, all while maintaining a highly profitable 30.5% pre-tax margin. But here is the really fascinating strategic nugget. A huge chunk of those $148 billion in new assets didn't just happen by accident. According to the report, over half of those net new inflows were related to client IPOs specifically captured through their workplace wealth channel. It perfectly illustrates how Morgan Stanley is strategically using its corporate and workplace relationships to funnel significant new wealth directly into its own asset management ecosystem. Section 4, Steady Investment Management. Let's transition to the third, slightly smaller, but incredibly vital engine. Now, the growth here is a bit more modest, about 6%, moving from $1.55 billion to $1.64 billion. But while it might not have that explosive 44% growth of institutional securities, it provides steady, consistent fuel to the overall $21.3 billion macro figure, primarily driven by asset management fees on those higher average assets. And speaking of those assets, this division successfully crossed its own massive milestone, reaching $2.0 trillion in total assets under management. This was supported by $7.5 billion in positive long-term net flows during the quarter. It just proves that positive capital flows are relentlessly happening across every single division of the firm. Section 5, Returns to the shareholders. We've looked at all the massive corporate numbers. Now let's bring it home and connect this directly back to the investor. And this brilliantly illustrates the payoff. Return on tangible common equity, or ROTCE, is a key profitability metric for banks. Morgan Stanley saw this significantly surge from 18.2% in Q2 of 2025 to 26.6% in Q2 of 2026. Basically, the firm's ability to generate incredibly strong returns on the equity it holds has accelerated dramatically. So how do those returns actually end up in your pocket if you're holding the stock? Let's rapid fire through this. The firm repurchased $1.5 billion of its own stock this quarter. Even more impressive, the board reauthorized a massive $20 billion multi-year share repurchase program. And on top of all that, they hiked the quarterly dividend by 15 cents to a juicy $1.15 per share. It's just a remarkably shareholder-friendly environment right now. So at the end of the day, we are left looking at a firm operating at absolute peak efficiency. Record revenues across the board, $10 trillion in client assets, and highly synchronized execution across the globe. It really begs the ultimate question. With a bar set this incredibly high, where does Morgan Stanley go from here? What does the future ceiling even look like for a financial giant operating at this unprecedented scale? It's a fascinating thought to leave you with. Thanks for tuning into this explainer and keep learning.